Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, May 8th, 2018. In this video, we'll take a look at a few of the things that stand out to me today, sort of a mishmash of a few different things, mainly focusing on QQQ and the top components of the Qs. Starting out here, this is just a recap or an update on the 60-minute chart. In my recent video, as well as some of the posts on the front page or right side of the chart, I pointed out these high-level bearish PPO crossovers that come shortly after overbought readings. So when we go back in time and you look at when I say in time, we're looking at all the overbought readings since that top back in the big top in early January of this year. So you can't, this is just cut off to the left of the chart. I didn't zoom back far enough, but I've gone over this recently, and as well as SPY. And my point is, we do have confirmed, you can see down here on the PPO histogram, the bearish cross is intact. We've made a bearish crossover after that overbought reading, and we are moving lower today. Not by a whole lot, only down 0.43. It's been mostly a sideways grind today. We look at the 1-minute chart. You can see this is yesterday's close, that dashed yellow line right here. And so we have been moving, I don't want to say consistently lower, but you can see the trend. That's been the trend today. Lower highs so far, lower lows, and the trend has been down. So it is a down day. We'll just have to see where we go from here. It's not. This is far from what I'd call impulsive selling. There's quite a bit of frustration in the trading, or at least mention of today being one of those choppy days. But again, I just wanted to point out, when you take a step back, even since yesterday's highs, coming off those overbought readings, that is your trend. A trend is defined by security or an index making a series of downtrend is a series of lower highs and lower lows, and so far that's what we have. But really be nice to see this selling start to pick up and become a little more impulsive. If it does, my targets, as I said earlier, for the Qs, we have support. These are minor support levels. This one's a little bit more significant down here, about 163.50ish or so. And based on the scope of these previous corrections, at this time I favor a pullback to this downtrend line. But if we don't get that, now keep in mind, if we don't get it, and this proves out, this I wouldn't call that flagging action. There's a little bit, you can see some sideways consolidation, that downward consolidation I mentioned just a minute ago on the 1-minute chart. It does somewhat take the guise of a bull flag. It's a little bit stretched, but you have to respect it. It would need to really break out today. We'd have to rally pretty hard into the close, and that's possible. And if so, then you could be looking at a bull flag that plays out, and then this is foiled. So that's one of the things I look for in the market. I look for a change of character. You go back, and I just showed you a whole handful of times where we've been overbought on the 60-minute, had those bearish crossovers on the PPO, and then corrected. But if we don't, then that's pretty bullish. It shows at least near term. Now, bigger picture, again, let's not forget when we take a step back and we look at QQQ, the big picture here is we remain locked in this sideways trading range, a big trading range. We can box it if we want. We can draw some trend lines. I just had a diamond pattern type, pattern on there, but this is the bottom line, and it's going to be frustrating for especially for typical swing traders that like to hold for weeks or months, or trend traders, because there is no trend right now in the market. The trend is sideways, defined by these large up and down rips within this larger range. So again, that's the bigger picture. If you're an active trader, like I said, this sell signal has worked in the past, so certainly I've shorted it. I added to my shorts today, seeing additional downside, and on that, let's just roll into the Qs and start out with Apple. Wrong symbol there. Here we go. On Apple, remember my right side in the trading room mentioned yesterday a potential gravestone doji, because I pointed out a potential at the time, a potential gravestone doji forming on XOP, the one of the energy sector ETFs. And so far, we were down earlier today. I'm doing this video. There's still almost an hour to go, so anything can happen. But as with any single candlestick pattern that is a potential topping or bottoming stick. A gravestone doji is a potential topping stick. I like to see confirmation via red candles downside after that. So right now we were down earlier. We're right about where we closed yesterday, but I want to see this candle red today. And then I want to see some follow through. If we close just slightly below, I want to see follow through tomorrow as well. So there's some potential for a reversal on Apple. And that's again, this is a chart without any annotations. Let me show you what Apple looks like on the daily chart. So here's the story on Apple. It's a pretty simple wash, rinse, repeat thing. I know I have a gazillion trend lines on this chart. You might not be able to make them all out, all the annotations here. But what I'm the red letters here say bearish rising wedge with divergent high, 12% correction right there. Divergent high, 9% correction. Divergent high, 10% correction. Divergent high, 10% correction. Divergent high here, I didn't measure it out. I'll do that for you right now. Off that last divergent high, 12% correction. Okay, so you're getting the idea. These are corrections that average about, close to 10% off these divergent highs. And this one is a series of divergent highs here. They're consecutive back-to-back divergent highs. You can see that the PPO, despite that, that bullish post earnings rally in Apple, and the PPO, do have to say, it is pointed straight up. That means the momentum is strong. The RSI is pointed up. And that means that there is the potential, if Apple continues to rally, to move on higher, take out these previous reaction highs in the PPO right here. I should draw it like this. Sorry, guys, that's a butcher job there. This previous reaction high, then you have this one here. This is really where this most recent divergence stems from. You could go all the way back here, but that's what I'm looking on Apple. And again, let's see. We need to see a red close today to firm up a bearish case, another red close tomorrow and later this week. And if not, maybe it burns through the divergences. I will say this is a weekly chart on Apple. You can see the divergent highs right here. This goes back a decade, by the way, guys. This is a 10-year weekly chart. This one played out. It doesn't look like much, but I'm sure that was double digits right there. This is log scaling. The bottom of the range is $11. The top is 200. That's what a log scaling chart will look like. You should always use log scaling on a stock with big moves. This is arithmetic scaling, renders a completely different technical picture. So again, log scaling, and you can see these corrections following the divergent highs and lows. There was a roughly 40% drop. There was a divergent low that told you to get long. So this is helping me formulate the bigger picture on Apple. Divergent high there, correction, divergent low, rally, and we have, as you can see right now, one of the largest divergences building on this stock on the weekly chart in a long time. And when we zoom in, you see what happened with Apple. We had a stick save. There's that key 40-week moving average I talk about. That has done just an excellent job of defining bull and bear trends on the weekly time frame. We had a brief, slight weekly close below it, but we snapped right back above it there, and we tested it here for a couple weeks, and then boom, with their earnings, we hammered off that level. So you had Apple successfully defending both trend line support, that white up trend line, as well as that 40-week moving average, which is the same as a 200-day moving average. So, until proven otherwise, the trend is still up in Apple, but you can see it. It has this wedging type action. There's the divergence, big negative divergence on the weekly chart. These are your levels to watch. Really, if we come back down soon and we take out last week's lows, I should say, last week's and the previous week's lows. So right about, let's move a line down or add another line here. Right about there. We take out those two candles. That will have also taken out the trend line as well as that 40-week moving average. So if you want to set a price alert, set it and forget it for, let's say, 160.40. If that one triggers, then tune into the weekly charts and watch Apple and see if you get a weekly close below that level, because that will tell us more than likely Apple's dropping down or headed down to at least this 134ish level in the coming months. But we're not there yet. Like I said, a lot of work to be done on Apple to firm up the bearish case. Let's move on to the rest of just a couple other FAANG stocks, and we'll get out of here. So let me go back to QQQ. And I have a watch list that pops up outside the screen here. I'm just clicking on the top components in order of market cap. So there's the day. I already covered Apple. Amazon. Amazon had that big earnings beat and sell off. This was that wedge. If you recall, the night that earnings came out and the stock was way up, I drew what the charts would look like the next day, and this is the wedge that I showed you here. I had added these yellow lines, and that's exactly what happened. We stopped at that wedge. You can see the potential divergence, but again, I have to reiterate, these momentum indicators for the time being are pointed up, but they can turn down in just a day or two, one or two bad days. So if they turn down, this would firm up the bearish case. You would have negative divergence. I also need to clarify that there is some potential to take out that previous high and still have divergence. If you see here as I draw these divergence lines, so if these momentum indicators go a little bit higher and then reverse, we still have negative divergence. So until and unless these previous highs are taken out, these reaction highs and the indicators right here. First would be this one right here, and then this one. Until that happens, we have negative divergence on just about all of the top leading stocks in this market. I'm going to get to a chart in a second that I show you how these stocks have been lifting the market. So that's that. There it is. Really, it's working its way up within this wedge. It's going to be frustrating. You don't have a sell signal until and unless this line breaks right here, this trend line. That would certainly be a sell signal. I could play around with this line here and tell you as well. Let's not spend too much time on Amazon. I think a majority of you out there probably trade the Qs because these top components move so heavy. That's usually my preference. You can short Apple or Amazon or short QQQ. And if you get the call right, you're a little more, you're a lot more diversified with QQQ. But if any of these big FAANG stocks go down, they all probably go down with the bunch. Here's Microsoft. There it is. Same story. As you can see, I sound like a broken record, but this is what stands out to me. And these divergences do work. Just because this one started back here doesn't mean it didn't pan out. In fact, it did. We had a correction on that first divergent high of 12%. Then we had a second divergent high and we dropped 11%. So where are we at today? It's just an extension of this divergence. There's two trend lines. I have two variations. This is probably the more important of the two, the white trend line down below. And like I continue to say, we're only a couple bad days, one or two really bad days away from breaking down below these trend lines on QQQ and these top stocks. But we're not there yet. I probably shouldn't spend time on the weekly chart too much, but same story. We're also right above these key weekly trend lines, and you can see what happened last time Microsoft broke. And this is what happens, guys. This is why I try to do these videos, and it might sound redundant. You have to be prepared because what will happen if they break, or more accurately, when they break, they're probably all going to break in conjunction, meaning all these FAANG stocks, a Qs, a SPY, you're going to see one of those big down days. They're going to retrofit the news headlines to why the market dropped so much, but I promise you it will be a technical event. And what happens is you have to be ready because once those key trend lines shatter, things move very fast. And the bulk of the move you can see in that case with Microsoft, it all happened within 1 week. And yeah, it took a few months, several months, about half a year. But in just 1 week, that one weekly candle dropped 15% and tried to kick back up, hit its highs. So you can see that boxed in area. And again, the point I'm trying to impress is how quick the selling kicks in once these well-defined trend lines do break. They've been successfully defended now for, past couple of months, really. But just keep an eye on them. Now, here's one that's not in a great precarious, it's in more of a precarious technical position or posture. And this is Alphabet. Here's class A, here's the other share class, and you can see, let me go back to a 2-day period chart. So what I'm looking at here, you can see this trend line here. This is a trend line pretty well defined off mid-2015, a lot of reactions along the way, and that trend line has given way, unlike some of the other market-leading FAANG stocks. So I'm just circling all the reactions. Somebody asked me, how do you draw, what's this? Any tips on drawing trend lines, and that's pretty much it. The more reactions you have, the more valid it is. So you had a breakdown a back test, and we're still trading below that level. We failed to regain that trend line on Alphabet. This is again going back 4 years on this chart here. So there's one in a, like I said, a precarious position, and that also came after a divergent high. There's that divergence. Divergent high one certainly played out for about they both played out for about equal drops, roughly about 15%. So two drops so far after this divergent high and this divergent high, about 15%. And the intermediate term outlook is not good for Alphabet unless it can somehow get back above that trend line. Facebook, not a whole lot stands out on this daily chart. There was a divergent high, and you can see, these divergences again, they're not the be all end all. They don't always play out, but much more often than not they do. There's about a 24% drop from that divergent high in Facebook. That was what I had put way up here when we had that divergent high. How far would we drop knowing we'd get a drop? So, and the technicals have played out well. We broke down, we back tested, and we back tested for a while, and then it gave up the ghost, just like Alphabet is back testing. Like I said, for a while, and it could suddenly just give up the ghost and then move down impulsively like Facebook did. So there's Facebook. We look at the bigger picture. Here's the best trend line that I can fit it on the weekly. Facebook got off to a rough start after the IPO. I predicted that at the time. I called it face plant before it even came out, making a case that it was extremely overvalued at the time of the IPO, and that was met with a lot of selling. That's why this chart only goes back to 2012. Usually these are 10 years on these weekly charts. So this is where trading really normalized. You can see this was a lot of big chop. And so I have a lot of reactions here on this trend line. So when I look at that trend line, that's a weekly stick. See how we made an intra-week break, but we closed right back on that trend line. So I like to try to capture as many shadows and or bodies of candles. That's a body, meaning it was a weekly stick save. So we have quite a few reactions, and there it is. There's Facebook broken down on the weekly time frame after a divergent high. It's not all drawn out here, not all the divergence lines aren't drawn, but there was your divergent high, and we're back testing. So the long-term chart again is not. This stock is in a precarious position. It hasn't completely given us evidence it's in a new bear trend at all. The trend still, the primary trend is higher, even though that trend line is broken, but it needs to regain it soon. And then we go back down to a 60-minute chart right here. You can see negative divergence on Facebook right there. I could probably draw a trend line as well to watch. Something along these lines. It's not a perfect trend line because I don't have a lot of reactions. Maybe something along these lines here. So let's move on to the next one and we'll wrap it up. Finally, I'll just go to Intel. Sometimes I call the group the FAAMG stocks, FAAMG, and then plus I. Intel's the sixth largest component. There's another one, big, roller coaster ride during earnings. We had a huge after hours ramp. The stock was up the next day, and then they faded all those gains and then some. This to me is bearish action. This speaks of a buying climax. We saw something similar to Apple back when they reported earnings on April 28th of 2015, if I recall the date right, and that was it. And Apple went on for one of the largest bear market actually that it's had since 2009. That stock dropped, I think, well over 40%, if I'm not mistaken, off that high in 2015. And so here's Intel. They, great earnings, blowout quarter, but it was met with a lot of selling. So like I always say, it's not what a company reports, how good their earnings are, how rosy and optimistic their guidance is. It's what is the market's reaction to that. For whatever reason, that their earnings was met with selling, and we're still well below that big red candle. That doesn't look good. And you can see here that we have a bearish rising wedge, negative divergence. We had divergence at that high, and we're only about a bad day or two away. Now, there is some work to be done. There's quite a few pretty decent support levels below, but I think if this wedge breaks, I think Intel's coming back down to this 43 to 41, 64-ish level over time. I think it would work its way there, but depends on how the breakdown occurs. If that breakdown occurs in conjunction with all those other FANG stocks and the broad markets breaking down, then I think you can get a very swift run down. If this one just happens to break down and work its way down while the rest go up, then it might be that zigzag scenario there. So like I said, the charts are dynamic. I have to look and see how things play out, but I don't like the look of this one. You don't have any evidence or reason to short it here yet because it's still working its way, in an uptrend like this. But if that trend line breaks and it's that 50-68 level, then maybe we'll have a sell signal there. And here's a chart. Might touch on crude if there's time here, but let me just share this chart. I posted it in the trading room today, but for the silver members or those of you that didn't have time, gold members that didn't have any time today to spend in the trading room, member Francis Q had posted some great analysis on some of the divergences divergences between some equal weighted indexes and the regular indexes. And as I posted yesterday, I was talking about the outperformance of the NASDAQ 100 versus the NASDAQ 100 equal weighted index. So that's what we're looking at here. And what I did with this chart, you can see the blue line right here is the index E. That's the equal weighted NASDAQ 100. And here's the regular NASDAQ 100, where those FAANG stocks are very top heavy. The top 10 components make up the bulk of the returns. And so what I did is I set the chart. Over time, there's these indexes have different values, of course. So what I did in this comparison, I overlaid them, setting them at the same point off the correction, that initial correction we had this year that started in late January, ended on February 9th. So I put them at that point there. And what this shows you is you can see this green and red line, that's the NASDAQ 100. It outperformed, meaning those big FANG stocks, those market leading stocks, that's what everybody wanted to buy for years and years and years. There have been people that, well, they didn't want to buy Apple. They said they did or thought about Apple, Google, Facebook, all those FANG stocks back, a couple years ago, but they didn't pull the trigger. And this is typical when you get in late stage bull markets. They want to buy those leaders now, so they bought them on a pullback. But what happened is those leaders got ahead of the equal weighted index. You had a correction. Again, they outperformed. You had another correction. At this point here, these 3 points here, you can see these 3 reaction lows. Those 2 lines came together. That means the NASDAQ 100, again, from this point, that's what I'm using, this point here, off that correction. When we had the sharp correction, because of forced selling in the index, they have to sell those market leading FANG stocks. The indexes, both of these two, reached parity. And then you started to have a rally. And again, the NASDAQ 100 outperformed the equal weighted index by quite a bit. And that was followed by, yet again, surprise, surprise, another correction down to a point of parity where the two came together. Again, off this relative performance off the February 19th lows. And so where are we at today? Well, there it is. You can see, as I mentioned recently, on this most recent advance, I've been watching it every day. I have a list of 100 plus actually 103 items that are within the NASDAQ 100, the QQQ holdings. I watch those, I sort them, I look at the top gainers, the losers, and that jives with what I've been seeing. Most of the heavy lifting, in fact, the majority of the heavy lifting on this advance has been done by one stock, Apple. Apple's done the bulk of this outperformance against the equal weighted. So where do we go from here? Well, again, who knows? Sometimes this outperformance can continue for a while, but as history shows us, you can just see by about, just eyeball the distance between and the amount of time it took on these rallies to get that outperformance, and then you get a mean reversion. So that's what I'm looking for right now. Markets are holding up surprisingly well. We're still down as I'm doing this video. The Qs are still down about 0.32%. SPY is down. Small caps are actually green. So it's not really, it's mostly a sideways to flattish day, but we'll have to see what happens the rest of the week. Okay, just to wrap it up, I told you most of my focus would be on the Qs and the market leading stocks, but there are some significant technical developments worth mentioning on crude oil today. We had a big reversal in the last update, and I did mention yesterday in the trading room that the DWT trade, the short on oil, was stopped out. We had the stop just barely clip before the reversal. And, heading into that, I pointed out we had negative divergence on the 60-minute charts. And you can see there those divergences have certainly played out. They played out for a correction. Somebody posted on the trading room that there was a fake news report with Trump and Iran earlier today that led to that sharp sell-off. We went right back down into the channel. And as I said at the time, I wasn't going to add DWT back just yet. I like to see, I never jump on knee-jerk reactions. That's what I said. I want to see what happens because sometimes when you see a sharp move like that, especially news baits, it's a knee-jerk reaction. And if that report is right, I didn't read the whole thing. I just take it on face value that the New York Times reported there was a fake news report from CNN on Iran and Trump. Either way, oil snapped back up. But now here's the thing. It's right now trading just a hair above the top of that recent trading range. So we're still, these divergences still could, and I suspect still might play out. I'm talking about this sideways trading range that went on from mid-April up until recent. We had this breakout, which I suspected may prove to be a bull trap or a false breakout. So far it has been because we have put in, and the reason is I don't take breakouts on divergent highs. I just don't because they're more prone to fail. And that one did fail. Now, if we continue to move back up, we burn out, take out the divergences, so be it. And oil's probably headed higher. But as of now, let's see what happens tomorrow into the rest of this week. You get a lot of momentum fueled overshoots. We are a hair above that 60-40 top of that trading range right now. But again, that may be just a momentum fueled spike from the reversal. Imagine a lot of shorts jumped in on that news and they're getting squeezed out. I suspect we're going to drift back down, fall back in the range. And then if we do, you want to watch the bottom of that range around 67 because I think we'll hit it and then probably continue lower. And the bigger picture remains this is USO, one trading proxy, and ETN for crude oil. The bigger picture remains that we have this on the daily chart, a divergent high. You can see today's big red reversal candle, trying to stick save, get back up there. These are the levels that, these are potential targets for that trade. Since DWT was the official trade, that stop was hit. This one was just put up as a proxy for those of you that didn't want to use the 3 times short leveraged ETN. This is a non-leveraged long, which you can short, and you can see this. The suggested stop I would have had on that was 1409. So let's just watch what happens. I'm not in a rush to put that trade back on officially. I've given my I was trading CL. I gave CL a little bit more room because of that divergent high, and I didn't see a lot of impulsive buying following that breakout. So I'm still hanging in there. I've been in that trade for weeks now and slightly down. Looking at another monitor, or am I down by 2% on the trade? Two and almost two and actually a little over, closer to 2.5 on that one. But giving it some room for now. But we'll see what happens within the next few days here. Again, these longer-term charts certainly have the potential to reverse, move down here, and if we break down below this uptrend line, there's a lot more downside. But you can see these PPO, the momentum indicators, are flattening out here. They could turn up. We could have another thrust up, but I do favor a thrust down within this wedge, and I will be monitoring crude closely this week, possibly into early next week for another potential short trade. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed.